Hi, I'm Kepner CPA here in Dallas. I have a client who had an insurance claim, had water damage in their building, damaged some of their equipment, and they got an insurance settlement. So the question is, how do you handle casualty loss? Well, if you're a business owner, your loss is determined by the difference in either the value of the equipment that was damaged or the cost, whichever is the lowest, less any insurance proceeds. So if you bought a piece of equipment for $10,000, its fair market value was $5,000, and you got a $4,000 settlement from your insurance company, then you would have a $1,000 casualty loss. And you can write that off in your business because you really sustained that loss. Now it's different for an individual. A non-business loss is calculated in a similar manner. The fair market value of whatever it was you lost, let's say your roof in a tornado, let's say that roof was worth $10,000. So you would go to your insurance company. If they paid you $9,000, then you would have a casualty loss of $1,000. Now the question is, can you write it off? Well, there are two elements that affect the non-business casualty losses. One is the first $100 of that is not deductible. Okay, so I can't even tell you why that's there. It's been there for years and years and years, but the first 100 is on you. So now you're down to a $900 loss. Well, you're also limited to 10% of your adjusted gross income. So let's say your adjusted gross income was $50,000 this year. 10% is $5,000. Your casualty loss is only $900, so too bad you don't get one. So think about what that means. It means that if it's a disastrous loss, then you have some tax deductions after you take into account insurance. Incidentally, when it comes to insurance, you've got to file your claim on time because Uncle Sam says you've got to collect first from the insurance before you make your calculation. You can be lazy, not collect from your insurance company, and then try to get Uncle Sam to pick up the rest. But the general rules or substance of the tax law is that unless it's a disastrous casualty, then you're simply going to eat that yourself. They figure that, meaning Uncle Sam, figures that 10% of what you made this year, you can afford to cover that loss yourself. So you have to have really good records. You have to have records about exactly what was lost. You've got to define it properly. No more than you would have to do for your own insurance company. You would also have to do on your tax return, and there's a form for that. I had another client that had a loss, a plumbing leak in their business, and it spread all over their business. It caused them to lose revenue, and so they went to their insurance company, and after about a year of negotiating, they received $150,000 of income. And of course, they didn't want to pay tax on that. But the reality is that if they had instead made that $150,000 in regular income, they would have paid tax on it. So this is just getting that income back in another form. So it is taxable income to them. They really had no loss. The insurance company made up for their lost revenue, so it's a taxable event to them. That's a lot different than things like liability claims or that kind of thing, where the question is, did the liability claim that the insurance company paid you get you back to where you were? And sometimes it does, sometimes it doesn't. Let's say you were hurt by the oil spill in the Gulf of Mexico, and it ruined your business. And so you got in with a group of people and you collectively sued British Petroleum, and you ended up with a big settlement. Is that taxable income or not? Well, the jury's out on some of that, because the reality is if it got you back to where you were, that is, it let you reincorporate, set up your business again and all that, that's just getting you back to where you were. Anything above that is probably taxable. Same thing if you got an injury claim that's a casualty. So even on an injury claim, not all the dollars that you get are going to be tax-free. So you lost an arm and your insurance pays you $75,000 for that. Well, that's probably not taxable income. But if they pay you $1,075,000 and the quote value of your left arm when you're right-handed is only $75,000, then probably part of that's taxable income, above and beyond what it costs to get you back to normal. So these are all very complicated areas, and some things are taxable, some are not. So if you lose an arm, we can give you a hand. Give us a call. Thanks.